Are you trying to find out the best investments for today's uncertain market? With the market facing uncertainty and the Fed likely to cut interest rates, finding the right investments is more important than ever. In this video, I will show you 3 top ETFs that can help you navigate this volatility. Whether you are looking for high growth tech stocks, stable blue chip companies, or reliable dividend payers ETFs, these ETFs offer a smart way to protect and grow your portfolio in these uncertain market conditions. Stay tuned to find out how you can make the most in these turbulent times. Let's get started. Thank you again for joining me today. I am Pankaj. As always, everything shared in this video is for informational purposes only. ETFs are a smart way to diversify your investments across different sectors in today's market. These funds include a variety of publicly traded companies and can be bought and sold like regular stocks. The companies in an ETF can be different. Some might focus on technology, while others may include dividend-paying companies. While ETFs can be as volatile as individual stocks, their diversity makes them a good choice for growing wealth over time. As we enter the third quarter of 2024, the economy is looking strong, but inflation is still a big concern. The Fed might lower interest rates anytime, which adds some extra uncertainty. In this situation, investing in high quality stocks with solid financials is a good way to protect your portfolio. ETFs that cover different industries can be especially useful in reducing risks during these uncertain times. Now let's take a look at 3 ETFs to buy this month. The first ETF on my list today is Invesco QQQ Trust with ticker symbol QQQ. While most ETFs track the S&P 500 index, the Invesco QQQ Trust tracks the Nasdaq 100 index. Nasdaq 100 index includes the top 100 non-financial companies with a strong focus on technology sector. Since Nasdaq 100 index is focusing on tech, it's not surprising that the Magnificent 7 stocks make up almost half of QQQ's portfolio. The surge in tech stocks this year has been a significant boost for this ETF. For example, Nvidia, which makes up 7.1% of this fund, has seen its shares jump by an impressive 134% year to date. With several tech companies offering positive forecasts, the Invesco QQQ Trust has strong potential to deliver good returns in long term. However, it's important to remember that while this ETF is heavily tech focused, it also includes a variety of communication sector stocks, consumer discretionary stocks, and healthcare stocks to add a layer of diversification. When it comes to performance, Invesco QQQ has consistently delivered greater results. Over the past 5 years, QQQ stock has gone up by 145%, outpacing both S&P 500 and Nasdaq Composite Index in average returns. This ETF offers a yield of 0.59% and remains relatively affordable with an expense ratio of just 0.2%. The fund's diverse portfolio helps balance the winners and losers in the market, contributing to its strong performance. Even with the recent plunge in tech stocks, the Invesco QQQ Trust continues to be one of the top ETFs for those seeking long-term growth in today's market. Second ETF on my list today is Vanguard S&P 500 ETF with ticker symbol VOO. The Vanguard's S&P 500 ETF is a great choice for diversifying your portfolio. As the name suggests, this ETF tracks the S&P 500, giving you access to a wide range of blue chip and dividend-paying stocks. The S&P 500 index represents the top 500 publicly traded companies and is one of the most closely watched stock market index. Major tech companies like Microsoft, Nvidia, and Apple are among the largest holdings in this fund. In terms of performance, VO has increased by 85% over the last 5 years. One of the best features of this ETF is the low expense ratio of just 0.03%, meaning that for every $10,000 invested, you only pay $3 in fees. While the market's uncertainty could lead to a pullback, VOO's exposure to a variety of industries makes it one of the best ETF to consider for long-term investment. My third and last pick for today is Schwab U.S. Dividend Equity ETF with ticker symbol SCHD. The Schwab U.S. Dividend Equity ETF, managed by Charles Schwab, holds over $57 billion in assets, making it one of the biggest large-cap ETFs available. This ETF tracks the Dow Jones U.S. Dividend 100 Index, which focuses on stocks with strong potential for long-term dividend payouts. SCHD has enjoyed 12 consecutive years of annual dividend increases. Unlike many large-cap ETFs that concentrate on growth stocks, SCHD focuses on value stocks, companies that are trading for less than their true worth. Picking individual value stocks can be tough for many investors, But SCHD simplifies this by offering a well-rounded mix of value stocks across sectors like finance, healthcare, energy, consumer cyclical, consumer defensive, and industrials. Over the past 5 years, SCHD has grown over by 54% and provides a yield of 3.55%. While there are other dividend ETFs with higher yields, SCHD stands out as one of the best options for investors due to its combination of value dividend stocks and diversified portfolio. When we summarize these three ETFs, we see that Triple Q has grown over 145% in last 5 years, whereas BU has grown by 86% and SCSD has grown by 54% in last 5 years. When we look at their expense ratio, Triple Q is the most expensive among the three with the expense ratio of 0.2%. BU has 0.03% and SCSD had 0.06%. When we look at the assets under management, BU is managing the most with $1.2 trillion. Triple Q is managing almost $273 billion of assets, and SCSD is managing $57 billion of assets. When we look at their dividends, SCSD is paying the maximum dividend with 3.55%, whereas WU has 1.3% dividend. Triple Q has the lowest with 0.59%. That's for today's video. If you enjoyed this analysis and want to stay updated with more investment insights, make sure to hit that like button and subscribe to our channel. Until next time, happy investing.